Welcome to the Insurance Stream. Happy Friday, everybody. It's Friday. You made it. We're on the home stretch for the weekend here. Today, we are going to be talking about the basic accounting need-to-knows. What you should know about your agency's accounting. We're going to go over the real basics here. We only got 5 minutes to do it in. So the very first thing we want to do, we want to give a shout out to Viva Virtual Assistants. They are the virtual assistants for the insurance world. They're college-educated Central America virtual assistants. They can help you with all your non-revenue generating tasks. Go over to theinsurancestream.com, click on agency services or services for your agency, click on virtual assistants, and they'll hook you right up with Viva. They're great. Again, they operate in the convenient central time zone, so no matter what time zone you're in, they will help you out. So on today's 5-minute insurance meditation, we're going to talk about the basic need-to-knows of agency accounting. So we're going to go over the real basic stuff. We're going to go over financial statements. So there's 4 types of financial statements. There's income statement, balance sheet, statement of owner's equity, and statement of cash flows. So some of your businesses are going to have these things run annually. Sometimes it's semi-annually, sometimes it's quarterly, and sometimes it's monthly. But basically, all of these reports in different ways give you information that you need to know when you're making decisions about the future of your agency. The very first one is the income statement. So the income statement reports all revenues and expenses during a specific accounting period. So it could be a 3-month period, could be a month period, could be the last 12 months ending on December 31st, your tax year more than likely. But these statements are referred to as a profit and loss or a P&L. So when somebody says, I want to see your P&L, what they're asking for is the income statement. The second type, the balance sheet. A balance sheet reports all assets, liabilities, and equity or capital, your money, in a company at a specific date and time, such as today, right? Today is Friday, August 18th, 2023. If you run a balance sheet for today, it's going to tell you everything, all your assets, all your liabilities, all your money, anything like that you have in your company as of this very day. So equity in a business is calculated as the difference between total assets and total liabilities. Although there's other complex components that can play into the equity section of a balance sheet, but on the most basic level, that's what it is. It's your assets, your liabilities, and your equity. All right, so that's the second one, the balance sheet. Number 3 is your owner equity. So the owner equity report summarizes the changes in the equity that you have, the owner, from the beginning of an accounting period, to the end of the accounting period. So if your entity is a sole proprietor or partnership, this statement will be referred to as, the statement of owner's equity. If you are a corporation or LLC, this statement is called the stockholder's equity report. So when you hear those words, that's what this means. So when the statement of stockholder equity contains information on paid-in capital and retained earnings, the statement of owner's equity or partner's equity will be a summary of all the contributions from the owners, increased by net income, decreased by losses, and decreased by member distributions or withdrawals, like cash you take out of your corporation or your LLC that is not part of your paycheck, part of your income. So you might also encounter a statement of changes in retained earnings or corporate entity. Although the statement of retained earnings may refer to the statement of stockholders' equity, a true statement of retained earnings details the beginning balance in retained earnings, transactions affecting the retained earnings during the accounting period, and then the ending balance in the retained earnings account. The last one is the statement of cash flow. A statement of cash flow details where all the cash in a business came from during an accounting period and where all of it went in that same period. It takes the information from both the income statement and the balance sheet, so it draws from 2 different reports, 2 different of these statements, and then reports cash generated and used during a specific time. So again, we've got your income statement that is all revenues and expenses during a specified period of time. You got your balance sheet that reports all your assets, liabilities, and equity as of a specific date. You've got your statement of stockholders' equity or owner's equity, depending upon the organization of your business. That refers to everything that's been paid in by you, everything that's retained earnings, everything that is a contribution from you, and then it increases by your net income and decreases by losses, and then decreases by withdrawals. And then the last one, again, statement of cash flow, where what cash came into your company and what cash left your company. We're going to follow up more on Saturday with how to increase profits with a revenue and expense review. So stay tuned for that. This has been your daily 5-minute insurance meditation.